everyone. As you guys can see, it's a solo show today. You're gonna have all stock savvy shy. Unfortunately, Katie had an emergency that was out of her control, and it's just gonna be me this morning. So let's let's see what the market is showing us today. So I will say the first where my eyes went when I woke up this morning was clearly the macro. What happened in the market on the jobs front? So we got private sector hiring rose by 37,000 in May, the lowest in more than 2 years. This was a huge miss. Like, this was not a casual miss where I think the estimates were 115K. We got 37. That is screaming sharp decline in labor demand. And I do think that this is not just like a random macro noise. Like, I do feel that in my own personal life and my own environment in the corporate world where this is a real indicator that tight monetary policy is kind of biting harder than expected. And we've had some rosy numbers in the prior months, but especially in the beginning of the year, I think the EDP president even made comments about that. But I think this is showing what the higher for longer interest rate environment is causing for enterprises. It's creating a chokehold, an anchor, because things aren't as great for business spending as a lot of people anticipate. Like this tariff war, you guys hear me constantly talk about this tariff war is causing paralysis, not just for consumers, but it's causing paralysis for enterprises. They're not going to be more willing to continue being aggressive on their aggressive hiring spree. They're going to kind of put their foot off the gas pedal, wait it out a bit until this tariff war poker game clears out. And I think today's private sector job number, you're seeing proof of that. So when job creation collapses this quickly, it does typically precede broader economic weakness where you're going to see obviously reduced consumer spend. That's an obvious when you can't get fill those jobs. You're going to see this lower small business confidence, which is the bread and butter of America. And you're also going to see some rising credit stress. So I do think that I'm looking on Polymarket right now. The odds of the rate cuts this year, the best odds from 0, 1, 2, 3, 4, 5. The number one leading cause is 0. That's the greatest odds right now. 0 rate cuts in 2025. That, in my opinion, is very alarming, especially after this ADP numbers that we're seeing, because I don't think cutting rates now would be premature. Wouldn't be premature. Like, it would be preemptive. And I know the Fed's mandate isn't just about killing inflation; it's also about preserving employment. That's the other part of the calculus. If the labor market is rolling over while inflation is it's trending down, although it's not as quickly as a lot of people want it to be. It is trending down. Holding rates too high risks over tightening into a slowdown that's already taking shape. That's my biggest fear because we've seen two huge pivot points in the past year or so, or past couple of years, where the Fed has maintained a status a little too long. They've overstayed their welcome a little too long, and they missed the time they should have pivoted. I don't want that happening again. I know that's typically Powell's mandate where he likes to play it safe, very data dependent. He wants there to be like 100, not 100%, but as close to 100% as proof in the pudding before making a big pivot. I just think right now is the time, especially when you get 37,000 uh, jobs in the private sector when the estimates were 115K. That's not a casual miss. That's a huge miss. All right, so that's like where my eyes went the macro front. I do think the market's digesting this pretty well. So again, when there's bad news and the market's reacting not poorly, that does tell me that we're in a really healthy bull market. And I do think this is typical in the summer months where it's quiet. There's low volume. Yesterday, I'm looking at let me look at the SPY right now for yesterday or Qs. Let's stay on the Qs. Yeah, I mean, yesterday volume was 40% less than average. Like it was a very low volume day yesterday. It was trending up all day yesterday as well. Yeah, I mean, it was just slow grind up. I think it's summer months are typically trend setting. And that's why it was so important in May that we kind of experienced that V-shaped recovery and we went above that 200-day moving average. And we not just went above it, we went through it with velocity and volume. And now we're trending towards all-time highs. I think that was huge to do before the summer months because summer months are always trend setting. All the whales are in the Hamptons, chilling, enjoying the sun. They're the only way to buck a narrative on a market is with institutional volume that has to kind of come and back it up a bit. So that's why it's really important to do that before the summer months. Now it's just gonna be trend setting. Nothing's gonna really um, drastically change on the downside, in my opinion. Like even you saw Z and Trump kind of point fingers at each other over the weekend, and the market just shrugged it off. Like that's it. Like they shrugged it off. So I think we're in this environment where it's going to take a lot to really turn this market around. I will say though, we're 2% away from all-time highs. The VIX is at 19. You guys hear me talk about all the time. The VIX mean is usually around the low teens. So whenever it hits like a 13, 12 or 13 handle, like in the past, I've like kind of bought some long-term puts as hedges because hedging is really cheap when the VIX is at 12 or 13. And I was like, all right, well, I think in the Trump-led presidency, especially the first 100 days, like there's going to be volatility. Like I'm just going to buy some hedges while they're cheap. Typically, when the market's at an all-time high, it's the VIX is below the mean. Right now, it's at 17 points. It's a little under 18. So like it actually, you can see yesterday, wow, it just dipped, slow drain. Um, throughout the day. So like I do think that the VIX is going to give out more. If it stays elevated, that might be a precursor to me that might experience this pullback because one of those two things have to give, like the equity price and the indices or the VIX. Either way, I do think that we're in a great place. I love how the market's digesting poor news, and I don't think much fireworks will happen in the indices in the near term. So let's talk about what else has happened outside the macro. My CrowdStrike. So CrowdStrike reported their earnings yesterday, and I highlighted how much I did not like the setup and the print. Why did I not like the setup? Like you guys hear me talk about the new age defense bucket that I'm hyper bullish on, where I put a lot of my soldiers into adding those names during this macro pullback in March and April. Um, it's because the DoD budget's evolving. Like it's going to be evolving away from missiles, jets, tanks towards um, threats that you can't see in real life. And CrowdStrike is the closest thing in the public markets to becoming that all-in-one cybersecurity platform for enterprise AI. And the issue is, I said it, the V-shaped recovery it's experiences the outage just 10 months. It was 10 months ago, guys, not even a year ago when they shut the world down. 10 months ago, it went significantly above the pre-outage price. I think what was the pre-outage price, Keith? I think it was 400. I'm looking over there. It was June 20. It was like around June 2023. Yeah, so like yeah, geez, see 380 was the pre-outage high. Went down to 232 very quickly. Again, this was my number one position when pre-outage. The hair you see over here, like that's contributed because of the hair I grew from that pullback. Either way, 380 was a pre-outage high. It was at 490 in this print. That's a 25% increase from pre-outage. However, their fundamentals are impacted still from that outage. I said it before where they were 30% free cash flow margins. They had a Rule of 40 score of 60 pre-outage. Now the Rule of 40 score is a 42, drastically different. It's because they need to still offer these credits due to the outage, and they're still penalized to appease all their clients and customers on their F up, but they're seeing their stock price not really react to the updated fundamentals. That Rule 40 score of 42, that multiple is drastically different than a company with a Rule 40 score of 60. Drastically different. But the stock price is not reflective of that. So I was like, ugh, it's trading at 25 times sales, 100 times free cash flow multiple. Yes, those free cash flow margins are just impacted this year and next year, and they're going to revert back towards the mean. But either way, it's still elevated. So they're really going to have some kind of, they need some reacceleration and upward surprise to maintain this multiple. And I just don't see that happening because of this outage anchor that they're still going through. It's a 2-year process. They're 1 year into it. So I think the expectations were a bit offsides on the market. I think you're seeing some profit taking, but I think it's really important to know when you narrative should not follow the price action for the stock, because that was that was a really strong print for what they're still going through. And the reason I say that is because, fine, like, guidance was a bit weak. I view it as more in line. It wasn't that weak. Uh, it was that, yeah, it was in line. When you're 1.10 billion versus 1.11 billion estimates, like, I view that as in line. Either way, I think it was a strong print, but strong. But none of that matters because when you trade at 25 times sales, 100 times free cash flow multiple, strong isn't good enough. So I think solid execution isn't just like um just chugging along on all these like traditional metrics. Like, you do need acceleration, and not just a beat, but guide up. And CrowdStrike's top line guidance just didn't offer that, which is fine because they're not allowed to, really, due to the outage. Instead, CrowdStrike told a very different story, one of friction, one of um, maturing growth that isn't as effortless as it used to be. Because I don't know if it's from the outage or that they're at this stage in their growth, but you're really seeing the numbers not re-accelerate on the module adoptions, for example. Like, it's still, I'm trying to pull up my notes on what I saw from here. Let me, okay, so they look like their margins are a bit capping out. Like, on the, you guys hear when I talk about modules yesterday. Modules are products. Like, endpoint is one module, identity is a second module, etc. SIEM is a third module. Like, these are all different products. Paula also has uh, a couple, three, maybe four. Sentinel One has a couple as well, two or three. CrowdStrike has 9. The average customer on their Falcon Flex is 9 modules. That's what I mean by they're becoming this all-in-one cybersecurity platform, that they have so many different offerings into their umbrella. Either way, when I go back to the module adoption, the customers who are using 6 or more modules, again, 2 times what all their competitors are offering. 3 quarters ago, that was at 46% of their customers were using 6+ modules. They reported 48% this cycle. And the last earnings cycle was also 48%. That was the first time there wasn't a sequential jump on the 6+ module adoption. And that's, I don't know if that's because of the outage anchor, or these were kind of nearing towards, like, maybe this is kind of where growth is capping off. Like, nobody knows yet. I think that's why it's like kind of selling off a bit. I don't think that's the reason, but it's something I track. It's really important to track these like under the hood metrics, because that really gives you pre-reads or precursors on what growth's going to be like in the future down the line. So, like, I don't love we didn't get any kind of sequential jump on 6+ modules. 7+ modules, same thing. First time in 2 years we did not get a sequential jump quarter to quarter on 7+ modules. I think it was capped at 32% last time last time I saw it. It's still great because, again, a year ago, I think it was at 28% of their customers using 7+ modules. Now it's 32%. Fine, that's still great. It's just there was no sequential jump. Uh, However, you can also make the argument that they call out 8+ modules now. I think that had a sequential jump. That was nice. So I think that's those are the kind of things I went through. I also do think that management did call out that there was ARR was slightly weaker than expected because they're decoupling away from that subscription revenue towards, again, more of a consumption uh lane. Again, this is a must, to be honest. Like, you guys hear me also talk about this all the time, where in this new world we're entering right now, the licensing model is dead. It's dying because AI agents will replace white collar jobs. So if I think teams of 10 will turn to teams of 6 in a couple years, these software companies who offer these licensing models are in trouble because these seats that they make their money on through these licensing models, they're based on actual headcounts and FTEs. So if I think FTEs are going to reduce by 40%, in a way, these companies who offer these licensing models have a 40% headwind then. So they have to kind of get ahead of that uh, headwind. And you're seeing servers now doing that with Raptors DB. You're seeing CrowdStrike get ahead of that with their Flex. Like, they're not idiots. These like blue chip SaaS high quality companies. They know what's coming. The AI tsunami, that's a component of that. That's one of the waves of that AI tsunami is that headcount reduction that's going to affect the licensing model. So we what I did see in that earnings yesterday was something that of a makings of a general like a generational compounding machine where Falcon Flex, their usage based licensing engine, exploded. That's all I care about. I want to see what their AI component is in under the hood that's going to be capitalized on a usage based model that is going to explode once AI agents really start scaling up. It really hasn't started scaling up yet. It's still in the early infant age. Uh, that it's going to scale up. So I do think I love that I saw Falcon Flex explode because they added like I think it was 750 or 800 million in incremental account value in one quarter. That's a 31% sequential jump. That's 600% year over year surge. Yes, very small base, but I loved what I saw with that. And that's incredible because it's not optimization. I do think it's a platform transformation, and it's not just about like a simple sales motion where there's going to go from selling licensing to usage based. Like it's not a new payment model. I do think this is like their Trojan horse uh, for platform consolidation, where it takes years, years long, like years, multiple years for sales cycles. And I do think Falcon Flex compresses this into months, and it does shift customer behavior from being cautious on module tests to now being able to full stack deployment. It changes how procurements work. I do think it changes how ARR compounds, and customers coming back in 5 months to re-up. Usually that takes a couple years. So I do think it made one thing clear: the Falcon Flex exploding the way it did last quarter is that demand is pulling forward at a machine speed. And when I say that machine speed, I'm not talking about just like a metaphor. It's really what CrowdStrike's kind of betting on it for the next chapter, where it's not just protecting enterprises from Gen AI threats. Like it's becoming that infrastructure layer that secures every AI agent, every autonomous workflow, every synthetic identity operating in the enterprise. And Charlotte AI, you guys heard me talk about that yesterday as well when Katie was making jokes about the names of these products, which is it's true. It's really funny, but it's not just typical AI wrapper. Like it is a preview of the future where SOCs are like don't scale by just adding humans or headcounts, like but by embedding reasoning engines or AI agents directly into the fabric of cybersecurity operations. So like I do think that this was a good print. It's down 8% pre-market on valuation at the end of the day. That's really it. And even if you zoom out, guess what? It's at a week low. It was is that where it was a week ago? And even after this pullback, it's up 35% this year. And this is with their fundamentals having a black eye still from the outage, which will go away. There's going to be a reacceleration. And Falcon Flex, that's the one thing you need to track if you're a CrowdStrike shareholder on when that reacceleration is going to happen, how quickly it's going to happen. I think it's going to happen a lot quicker than people anticipate, especially with that massive sequential jump that we experienced. So I think that this was a really good. I'm happy with it. I'm willing to take a brief pullback. I don't know if it's going to get bought because it did catch a bid. It really did catch a bid entering this print, and that's something to be cautious of. So now let's talk about one of the other mythical events that are happening in the market that I think a lot of people are dumbfounded about. Not just me, and I'm not just being a hater, guys. Like I know the space really well, and what's happening to this specific stock is absolutely euphoric. CoreWeave. what is happening to CoreWeave? What the it was it IPO'd at $35 or something? It's at $150. It's moving like it's just a video game numbers the way it's moving. And I think that it's a little not manipulating. It's just you can't short the stock yet, so it's like difficult to bet against it. Uh, Also the puts, if you want to buy puts, like good luck. Do you see the IVs on those puts? It's like 150%. Any option trader knows they're not going to, the juice is not there to squeeze on a contract that's worth 150% IV. But also when it's breaking out like this, it's in pure price discovery mode. You don't want to get ahead of that train. However, I'm telling you guys this. This is not a $70 billion company. It's not. I don't care what it does right now in the near term. When I make these comments, I'm always 5+ years out. Always. I'm a thematic investor. If you're a thematic investor, you invest with that kind of timeline long term. In the short term, great job trading this name, guys. Great job. This is not an investment. I could care less what this. That price action does not drive my sentiment. And CoreWeave being a $70 billion company, I do think it deserves to be a future business school case study because a company with negative earnings, again, they do not make money yet. They're built on a fragile triangle. One chip vendor, NVIDIA. NVIDIA supplies demand. One hyperscaler, Microsoft drives the demand, Azure. One fleeting window of silicon scarcity, guys, we NVIDIA comments all the time that supply is still a constraint. It's still an issue, but that's going to line up eventually. Demand's going to meet it. So I think CoreWeave right now, they don't own the computes because they have to go through NVIDIA. They don't own the customer. Microsoft's literally just driving all the demand. It's literally renting the moments, and moments don't scale. I don't care what anyone says; they just don't scale. And I think that, like from the distance, like the numbers might look impressive. I agree. Like if you just go based on traditional metrics, they look really impressive. Surging revenue, big name partnerships, like clearly they're renting the moment, but nobody knows how long that moment is. But it's a massive AI talent. But if you strip away the surface and you're left with a structurally fragile business, because this is not a vertically integrated infrastructure. It's a margin rental, a company built like on that triangle I talked about. So what it owns is really the spread, if you want to be honest. Like it's not the Vegas books. Like I want to compare that, but it's an arbitrage between hyperscaler demand and available GPU supply. That's end of the day. They're a broker. But that spread only exists because of that temporary mismatch. It's temporary. It's not a structural advantage. It's not the fourth um, hyperscaler cloud. And when that mismatch corrects, like either through more normalized GPU allocation, if you're on the side that China is just gonna really accelerate their ceiling of IP on the US side or whatever happening with oh my god, Huawei. I'm butchering that name. I will never get that name right. But you guys know who I'm talking about. Or even the post DeepSeek world, like I think it's gonna be tricky for them. Like right now, there's a massive sovereign build out. You saw it in Middle East. Nvidia is doing a European tour this week as well. So I think that again, the moment's great, but it's renting that moment. There's no mode here. There's no control layer. There's no embedded distribution. And it's just a bet that Nvidia keeps funneling hardware its way and that hyperscalers won't bypass them. But that's not a thesis I want to underwrite. It shouldn't be a thesis that anyone wants to underwrite if you're a long-term investor. And I do think that moments like this don't scale. They eventually fade. If you guys want to see a case study, let's look at SMCI. That moment failed. It's very different business than what CoreWeave did, but SMC had a first mover advantage. That's why they did so well. Like liquid cooling offerings is great for the servers, but HPE and Dell, it didn't take much for them to kind of get into that space and kind of capitalize on what SMCI initially did. And now you saw their gross margins just deteriorate for years. And right now it's doing well, but it's a renting the moment again. It's just not going to do too well. So I think CoreWeave, like also you have to factor in like CoreWeave will constantly have to pay for the latest and greatest hardware, Blackwell chips. What's after black gold chips? Ruben. What's after Ruben? I'm blanking on the name, but you get what I'm getting at. Every time they acquire this hardware, the depreciation on that hardware is aggressive as well. I just don't see any margin expansion opportunity for a CoreWeave. I just don't see it. And you need um you just need to have margin expansion to really justify a stock price move like this, and we're just not seeing it. So I do think that core review is a fun thing to watch, future based case study, but I'm not bullish on it at all. I don't think it, should be as well long term, but we'll see if I'm wrong with that. I'm wrong with hymns, but let's see. We're at the bell to beautiful. So market right now, it's going nowhere. It's catching a little bit. But I just think it's just gonna be one of those dead days. Spy Spy's like hovering around the 7-day EMA, which is a good thing. Like it's not really breaking out, it's not really pulling back, it's just chilling. That's usually a great sign of just like a healthy bull market that it's consolidating a bit. I will say you guys hear me talk about RSI, and the reason why I thought April 7th was a bottom is because the RSI daily RSI relative strength index was at a 20, and that was the lowest it's been. I'm trying to see since the COVID bottom was the lowest it's been. I was like, guys, I know this terraform it's man made, but like it's not as bad as what COVID was. Like I think there's gonna be a bottom. So the daily RSI on SPY is at a 65. Typically, anything above a 70 is really overbought. We're trending towards there. And last time we hit a 70 was December 2024. And what happened there? Let's see. December 2024. Yeah, I mean we had a pullback from 610 all the way down to 575. I don't think we'll have that much of a pullback, but keep in mind we are a little overextended. I think we need to consolidate a bit. Like what they're doing right now, what the indices are doing right now is just chilling at the 7-day EMA level, which is great, and just letting time like it phase out. But I think this is what I think is going to happen. They're going to hang out around here. The VIX is starting to drain towards the mean of below 15, and we're in the summer months where like, not much will happen, low volume. But yeah, I mean, one last thing, CrowdStrike is down. It's kind of holding a bit. It's down 7.5%. Uh, yeah, this name deserves. It was running too quickly. It was running too quickly. But if you look at their 21-day EMA, it's at 449. So that's the level I'm watching for them to see if that protects it. It looks like it's protecting it a bit. It's just hard for people to sell this name on what's so obvious of just a bruise or a black eye on their earnings that's going to go away. And the market is a forward-looking mechanism. They see wow, Falcon Flex is really scaling up pretty quickly. And who knows what CrowdStrike's fundamentals will be in a usage based model versus what's traditionally been a logo and licensing. So that's really exciting to see. And I think everyone can agree cybersecurity is going to be even more important in the future than it is today. And there's only so many elite names in that space. So yeah, hopefully it's gonna be a short show because it was only me. I pulled Justin Timberlake a bit today. Got away from my NSYNC band. Uh, I be safe out there. I don't think many things much will happen today. So take advantage of that by going to the lab, doing the conviction, doing the research. And when things return back, by return back, I mean when volatility comes back, be prepared. Have that list because I know a lot of people like they were caught off guard with this V-shaped recovery and they weren't able to add to a lot of the names they wanted to add. So have that list ready because when April 7th happened, like I had that risk. Like the new age defense bucket, that was my list. Axon, Cloudflare, CrowdStrike, Palantir, Rubric, like those are the names. Like I want that to be like 50% of my portfolio. And luckily I was really aggressive. I gave my performance a B, not even an A during that pullback because I had a 10% cash position still. But either way, like I increased my allocation towards those names and I had a plan. So always be prepared, have a plan. Don't get too greedy. Don't overtrade this market because it's approaching that overbought level, and I think it needs to cool off a bit or just consolidate. And yeah, prioritize some other things in your life right now, like doing that research that takes some time. But thanks for hopping on. Tune in tomorrow morning. We're gonna have a fun guest on that him and I are gonna do a debate on one popular stock that has becoming more of a polarizing name out there that I think will be a lot of alpha that's gonna be found tomorrow. Thanks, everyone.